Thanks for the introduction. Today I'm going to be giving a presentation on gold. Gold in 2020, global pandemic, soaring debt, and the threat of war. Gold is money, and I also believe it's the insurance that everybody needs to have given the financial and social calamity that we're seeing today. Today I'm going to talk about why gold is trading at an all-time high and why I think it's set to go much further and how to profit. So gold is trading above $1,900 an ounce, and there's two reasons why. First is the COVID-19 pandemic, and second is the social unrest and the potential for war. So first, starting with the COVID-19 pandemic, really, I believe this is the straw that broke the camel's back. The lockdown in March, shut down the global economy, an unprecedented step. People lost jobs around the world. Sectors, it looks like they might even be destroyed. Restaurants may never be the same. We really don't know the full consequences of this, unprecedented step. In response to this, to these moves, interest rates have been cut back down to 0%. And taking the U.S. as an example, Jerome Powell, the Federal Reserve Chair, said we should see 0% interest rates for the next couple of years. So basically, for the foreseeable future, we're going to be at ultra low interest rates. Further, it may be even easier for all of us to get our heads around are the massive amounts of stimulus that have been pledged around the world. We use the U.S. as an example. The Fed pledged, 1.5 trillion in expansion of repo operations. In an unprecedented step, they entered the corporate bond market. This has never happened before, and really not really sure about how this is going to work out. They've launched the money market mutual fund liquidity facility, and that's around 10 billion. And then of course there's the CARES Act, and that's around 2.3 trillion. And that breaks down, $1,200 per person, $500 per child, additional $600 per week for the unemployed, 500 billion for businesses affected by the virus. The list keeps on going, and there's a ton of money that's been put into the economy. And so debt is soaring around the world, and it's not just the US. The Eurozone, I believe it was just over a week ago, pledged 2 trillion in COVID economic relief. And of course, a couple weeks ago, Canada came out with a projected deficit of 343 billion in 2021. And on a per capita or per GDP basis, this is a huge amount for Canadians. And really, there's no end to this spending in sight. And I think this is something we're going to see continue as governments are becoming a larger part of the global economy. And really, this isn't a good thing. So now we go to the second point, and this is social unrest and the potential for war. And talking about social unrest, and really what I think is at the core for the social unrest is the wealth gap. And in my view, the wealth gap between rich and poor is directly related to that last slide. It's basically all of those, quantitative easing, low interest rates, everything that has been, brought into fruition with the governments to ease supposedly our daily lives only adds, to a devaluing of the dollar and ultimately these crashes that we see. And really, it's only the rich that can benefit fully from these crashes and buy assets when they're cheap. Businesses, real estate, the stock market, they're able to deploy cash they have on hand, or they're able to take out loans from banks to take advantage of it, while the middle class and poor really either don't have the willingness or the ability to buy things when they're cheap. And therefore, this wealth gap continues to grow. And unfortunately, I see this only continuing in the future. Another big point, the US election on the horizon, the political ideologies between left and right have never been more polarized in my view. And the problem with this is no matter who wins in the election this fall, 50% of the population is going to be upset. And I think when you coincide this with the wealth gap growing, I think protests, riots, violence, are a thing probably that's going to follow us for the next little while until we get a handle on what's going on here. Now we move on to the potential of war, and we actually might be at modern warfare right now, and it would be a financial one. And of course, the opponent, so to speak, would be China. There's a lot of different things going on financially with China right now. You see the tit for tat orders for closures for embassies in both countries. There's a really big potential catalyst or conflict growing in the South China Sea. The U.S. has openly said that they don't recognize China's claim on a portion of the islands, and this could be a big contested item moving forward. And then finally, you have the financial sanctions that were brought by the U.S. on China over the human rights violations. And it's not just the U.S. There's a few other countries that have joined the party to inflict financial sanctions on China, given what's going on in the country. And the Chinese, the different spokespeople have said that there will be a retaliation to some degree, and it should be interesting for the coming weeks and months what this ends up being. Unfortunately, I think there's a strong parallel. If you look to the 1929 crash, of course, the Depression era over the 30s, and then the lead up to World War II, it's eerily similar. And I hope and pray that we're not headed this way, but it looks like it could be a possibility. So in saying that, I think the price of gold is only going to go higher. You look at the 10-year chart here. The last time we were at this level was 2011. Of course, today, we're trading above the all-time high, above 1920, and really, I think gold is going much higher. Unfortunately, like the late Richard Russell says, in the next crisis, it isn't who makes the most, but loses the least. And I think these are very wise words. As a high gold price is good for resource sector investors and holders of gold, but the flip side is gold really is a barometer of the global financial system. And clearly, gold is telling us that something's wrong. So how do you profit? In my view, it's speculation within the junior companies, and it's in two main types of companies: exploration and M&A candidates. Before getting into those specifically, let's take a look at the VanEck ETF GDXJ. And I want you to get a picture of how undervalued the sector on a whole is right now. You go back to 2011 when the old high was 1920, and you can see the GDXJ was valued over $150. Fast forward to today, gold is trading above 1920, and the GDXJ is just over $50. Clearly, there is room to move up. The sector is undervalued. So the first type of company that I like to talk about is exploration. When it comes down to it, in my view, the market is hungry for discovery. If you look over the last couple of weeks, months, the market has been paying companies that have come out with great drill results. And I think this will continue in the future, especially as the gold and silver prices begin to go further or higher. Remember, the caveat with exploration is that it absolutely comes with the highest amount of risk. The fact is, most companies will be unsuccessful in getting that good drill hole. So investors need to balance that risk to reward. And you need to pick the right people that have the right projects and the cash to execute to make those discoveries. Second are the M&A candidates, and this covers both developmental and producing companies. Developmental are companies that have deposits and they're working towards expanding these and getting economic studies so they can lead to being a producer. And then of course, a producing company is a producing company. I think there'll be three main criteria that senior mining companies will be looking at for their top mergers and acquisition candidates. And I think it begins first with first quartile economics. While the last cycle was characterized by senior companies adding marginal ounces in the ground that were super cheap, but made their balance sheets look great and really didn't work out that well, I think this cycle is going to be more characterized, at least in the beginning, with companies going for quality over quantity, at least in the beginning. Low all-in sustaining cash costs protect the downside risk of the senior companies over the mine life. And these mine lives are over 10 years, typically. And you want to protect that downside risk because you don't know where the metal price is headed over a decade. Second to that, I think size matters. For senior companies, they want to make an impact to their bottom line. And therefore, I think they're going to be targeting deposits or projects that have over at least 2.5 million ounces in total resources. Second to that, I think they want to see a minimum of 100,000 ounces of possible or potential gold production in a year. And then tertiary is a large land package. The senior companies want to be able to potentially expand their existing deposit and possibly find other deposits within their property. The second point is jurisdiction. I believe tier 1 jurisdictions will be the focus of the senior companies. Second and third tier jurisdictions, while there might be some intriguing projects, I think the uncertainty that is flowing throughout the world will focus senior companies on the best jurisdictions. Canada, the United States, Australia, Japan, and parts of Europe. And finally, even though we live in a society of low interest rates, essentially free money, I believe low upfront capital costs is going to be, again, that third point that senior companies are going to be looking at. And it's an attempt to reduce the risk and exposure to an uncertain market. And then just one key point with that, remember, it's all relative. Big projects have big costs. So you need to be able to delineate how that big cost and big project against these smaller projects. Putting it all together, gold is trading at an all-time high, and I believe is poised to go much higher. I believe there's a golden opportunity in the junior gold companies. The sector is undervalued. The market is hungry for discoveries, and I believe we're on the cusp of an M&A frenzy like we've never seen before. Thank you very much for having me, and good luck.